Good morning, and happy Monday to everybody. Welcome to an episode of Monday Mortgage Live. My name is Michael Anthony St.Claire, and I'm going to be sharing with you a couple different tips as far as what's going on in the market in the event that you're purchasing a home and or just looking into refinancing. Nevertheless, rates have been phenomenal, mainly for the last almost 24 months. Ever since the whole pandemic began, we saw a big shift in mortgage rates. We even saw record lows, rates that were under 2%. And as we got into 2021, we started to see more of the norm was around 2.5, 2.875, in those ranges. As we're shifting closer into 2022, we're going to start to notice that the Fed is going to start to be backing off of mortgage bonds. So you'll see a lot of headline news as far as Fed fund rates, increase rates. And there's a lot of confusion with that. I'm not going to dive into all of that now. But what you do want to be cognizant of is come November. November, there's a big Fed meeting happening, and this is when they're supposedly going to be announcing these specific dates, or at least timing of when they're going to start tapering back on mortgage bonds. When this happens, at least the chatter of mortgage rates being tapered, you're going to see a lot of investors to make shifts in the market. Some of that has already played out, as the different Fed chairmen have been alluding to that they are going to be tapering, whether it's at the end of this year or the beginning of next year, which we have seen the results of rates starting to increase because of that. So rates are hovering somewhere closer to around 3.25, 3.5. They took a real big hit last week with job reports coming out. Now, normally job reports would help as far as interest rates, if you will. Job reports being lower would ultimately show that we have a weaker economy. And typically, when we have a weaker economy, we'll start to notice bond prices will become a little bit cheaper, kind of signaling, if you will, to more buyers coming into market, which ultimately makes rates a little bit cheaper. That's not the case, and that's not what we've seen as of last week. As of today, right now, the market is closed. But if we kind of take a peek and see where mortgage rates are at, or at least where they finished last week, if you will, I'll make some green lines so this way you kind of have an idea of what I'm looking at here. But this line right over here that I just drew out on this chart, if you can see it on your screen, this is ultimately going to become our resistance. And we've had a major drop down from this range over here. Let me draw another green line for that. Right over here, we had a pretty big significant drop. This was back towards the end of September. So as you can see, the trajectory has been doing nothing but going down. Not mortgage rates, we're talking about bonds. So ultimately, this is making rates a little bit more expensive. You're seeing a difference in price rates. So much so that interest rates that are in the 2 percentiles, and I'm referring to 30-year fixes here, folks, not 10-year programs, not 15-year programs. Segway, some people will tell you rates are still in the 2%. Yeah, but that's probably a 10-year or 15-year or maybe even an adjustable rate mortgage. What I'm alluding to is what about 90% of most homeowners, first-time homeowners, even existing homeowners, are looking at when it comes to where can I save some money? Where can I reduce my payments? And we're talking about 30-year fixed notes. These rates are hovering above 2 percentiles. They're well into the 3 percentiles. And do I see that coming back down to the 2%? We may have a nice little, what we would call a fake out, if you will, where rates start to show improvement, and then all of a sudden we're going to have a big drop again. Do I see that trend happening between now and November? Very possible. However, one of the instruments that I'm following, if you will, is going to be U.S. Treasuries. And U.S. Treasuries last week actually showed some movement where they broke through a resistance area, which I'll draw a green line for it here. If you can see on your chart, Treasuries broke through this just last week, which ultimately this sent mortgage bonds where they're at currently right now. This is where you see the big drop off right here. So ultimately, if we have Treasuries where their next potential mark is going to be right up here, which is the 1639 mark, I would anticipate to see rates closer to around 3.7, 3.8. They're hovering around 3.25, 3%, depending on your scenario. If you do want to find an interest rate that has a 2 in front of it, they're out there, but you're going to be paying points. So just Don't let that fool you, or don't let that surprise you when it comes to mortgage rates in today's market. Now, if you are an existing homeowner, I do want to share with you that as we get into holiday season, there is a hack, if you will, on how to save a couple $1,000s, a couple mortgage payments, if you will, before the year's out. Ultimately, anytime you're refinancing your mortgage, you will have a payment deferment, if you will. There's prepaid interest that is collected for on a refinance transaction, and that's all kind of bulked into your loan. So essentially, all your costs are bulked into your closing costs. Prepaid interest as a part of that closing cost is bulked in there. That prepaid interest is important because you're paying interest in advance. Therefore, you're going to have a break in your monthly mortgage payment. Typically, it can be anywhere from 30 days to about 60 days. Why is that important? Because I mentioned we're in holiday season, and if you chose to refinance before, which timing I would do it right after November. I'll explain more of that in a minute. But I would look into closing after the 7th of November, somewhere in that timeline. This way you'll be able to get your November mortgage payment off, because that payment would have already gone out by the 1st or 2nd or the 5th. So you'll be able to avoid actually having to make another payment or making a payment at all, because it's included in your payoff. You'll skip your December payments, and then ultimately your first mortgage payment would be in January. You can obviously do this inside of October if you wanted to, but the reason why I would do it after November is because in the state of Florida, specific to Florida, property taxes are due in November. At least that's when the property taxes become due. And if you're already escrowed in with your existing mortgage company, they're going to pay that out. If you close beforehand, you're going to be getting those monies back. However, for your refinance transaction, they're going to be collecting a big chunk of your property taxes to pay that. So that way, when your first payment becomes due, taxes can go right out with it. So strategically, I would be closing anytime after November 7th, if you will. As I mentioned before, if you are going to be making, closing inside the month of November, and you have automatic payment withdrawals from your account, I would look into cutting that off if you're closing inside the month of November, because ultimately your existing lender is going to get paid twice, and then you're sitting waiting to get an overage check back. So just some tips I want to share with you guys in regards to rates, a good tactic for you guys to save some money right in the holiday season. And ultimately, if you have any questions or even concerns about your current finance situation, want to get to a better place, leave your questions in the comment section, or feel free to reach out to me direct. All my information will be in the description. Outside of that, have a phenomenal week, and I'll talk to you guys soon.